Proctorio, so use your laptop. And I am going to allow use of Excel as a calculator if you would like. You can only pull up a blank sheet, so you can use a non-programmable calculator, or you can use your Proctorio calculator, or you can use Excel. But just remember that Excel is gonna be recorded on your screen, just like the exam. So if I need to look at it and proctor it, then I will. So those are your options. Just to remind you, you get an 8.5 by 11 sheet, just like this, front and back, printed, written, pictures, whatever you want. That's your crib sheet for your exam. Other than that, it's a closed book exam. I did just post, I got a lot of requests. This is my 4th class. This is my 4th section in accounting 3320 cost management, and I really got a request for a practice exam. So I posted a practice exam onto Canvas, as well as the solutions. And now, a lot of that practice exam is what I've already been taking you through in these lecture notes and working through, but it gives you another chance to kind of check yourself, see what you feel comfortable with, and then you have the solutions. All right? Any questions about the exam, any specifics? If you have accommodations, I've sent you a separate email, and I'm gonna make that separately. All right? Yes?
How many questions is it?
22. So probably, we're gonna go through it. If we have time, at the end, I'm gonna kind of give you a summary of some exam. I won't show it to you, but I want to kind of walk you through it. So several multiple choice of matching, and then of course several problems. All right? So let's talk about job costing. We did this problem on Monday, but I felt like I did a very poor job on working through the math, so we're gonna do it again. I am gonna tell you that you're not gonna be asked to calculate salary on the exam, because I think it's too algebraic, and we're not learning algebra in this class, we're learning cost accounting. So if that makes you feel better, but I am gonna walk you back through it just in case I confused you, and I want you to kind of know the pieces that go into job costing. So we'll do the easy one first, and I will tell you, you will see this almost exact same thing on the exam. So remember what this is job costing, not of a product, but in a service organization. So you're building up the cost of a service organization and then determining what you would charge your clients so that you can earn the operating income margin that you want and cover all of your indirect costs. So that's the main difference between a service costing and a job costing. So in this particular situation, we have Buff Consulting, and your friend that went to work for Buff Consulting and makes bills. She doesn't make, she bills to $350 an hour and 3,000 hours a year. And then we were given a budgeted operating profit margin of 40%, and then allocation of indirect cost is at a budgeted rate of 275% of the professional salary cost. So the first part of this question is, how much budgeted revenue does your friend contribute to Buff Consulting? I'm gonna run through this one pretty quick since we already did it, but I wanna remind you that we were told that she makes, oh, sorry, I don't have the pin in the right mode. She makes $350 an hour, and she bills 3,000 hours a year. And you do that math, and the revenue that she contributes, the budgeted revenue she contributes, would be $1,050,050. So that's pretty straightforward. Your rate times your hours gives you your revenue, and you will see that. There'll be a very similar question on the exam. Different numbers, blah, 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 okay? So then the next one was, what is your friend's salary? And salary, I just wanna make sure you know that salary is your professional labor cost, okay? And we don't have that number, so we don't know how to apply the 275% to get the indirect cost. So I'm gonna walk you through again how we get this, and then I'm gonna talk you through what you're gonna see versus something as complicated as this, but I do want to walk through it because I went over it the other day. So just remember that when we are calculating, when we're doing a calculation on a service organization, we should remember this formula. Operating profit, and this is for a service organization. I'm gonna write this up here. So operating profit equals revenue minus professional labor cost minus indirect cost. Can somebody tell me what we mean by indirect cost? Or shall I give you an example? So remember, in a consulting firm, or a law firm, or an accounting firm, you generate labor through professional labor. But then there's a lot of indirect cost. You have a corporate building, you have human resources, you have information technology, you have administrative, you have an accounting department. Those are all of those indirect costs, and it's still a cost of doing business, and you have to apply a markup rate to that in order to make sure you're costing out a service job appropriately. So now that I have these, we're solving for S equals salary, which is also the same as professional labor, okay? So I'm gonna put down what we know from the problem. So operating profit, we were told that we have an operating margin of 40%, and we're gonna multiply that by our revenue to get operating profit. And then I'm gonna keep plugging into what we know into this formula. We know we have revenue of $1,050,050, because we just calculated on the previous slide, minus S, because we don't know what the professional labor is, minus 275% of S, because that is the rate at which we apply indirect cost. So let's just keep going. I'm gonna do the math here. 40% of $1,450,000 is 420,000. Equal $1,050,000. And then we're gonna combine these like terms. So let's convert 275% into 2.75, that's just easier math, right? And we have 1S, so we have minus 1S minus 2.75, so that becomes minus 3.75S. Okay? And then we're gonna keep solving, and again, it's an algebraic equation, so that's why I'm gonna walk you through it, and then we'll go from there. So what we're gonna do here is we wanna isolate the 3.75, so we have a negative 3.75, so we're gonna add 3.75S to each side. Sorry, my pen is not working right here. Come on, little pen. And that cancels out this 3.75S. So then we get 420,000 plus 3.75S equals $1,050,000. And then we're still trying to isolate S, sorry. We're gonna keep working to isolate S, because that's what we're solving for. So we're gonna take minus 420 from each side. Cancels that out, and then we have 3.75S. Sorry, fourth lecture today, my throat must be getting really dry. 1,050,000 minus 420 is $630,000. Divide by 3.75, and your S equals 630 divided by 3.75, which gives you $168,000, and that's the salary. So what you're gonna see on the exam, you won't be asked to calculate salary. Again, I think this is pretty complex, but I still wanted to walk you through it to make sure you understand the pieces. So what you will be given on the exam is you'll be given revenue, and you'll be given direct professional labor, which is the equivalent of the salary, and you'll be given indirect cost, and then you'll be asked to calculate operating income, and then calculate an operating income percentage for a particular job. So I would just spend some time maybe going back and reviewing and making sure you understand how you apply operating margin percentage to a job in order to calculate operating income. Okay? Is that clear as mud? Yeah. All right, so when we go through the exam, I'll walk you through it a little bit more, all right? So let's move on. So we're gonna do, this is another job costing exercise. So I'm gonna walk you through it, and then I'll talk through what it is specifically different about this one that you will see on the exam. And in this case, we are manufacturing microcomputers, and production takes place in two departments, Department 1 and Department 2. In April, there was a budgeted allocation base of 5,000 hours in Department 1. Notice that 5,000 machine hours in Department 1. And there was budgeted allocation base of 2,500 direct manufacturing labor hours in Department 2. And how this problem is different than the problems we've been doing is that these two departments have an allocation base of a different unit. Department 1 is machine hours, Department 2 is direct labor hours. So you'll need to calculate your budgeted rate and then apply it on these two different factors. So I'll keep walking you through it. We have budgeted manufacturing overhead of 23,000 in Department 1 and 25,000 in Department 2. And then we're given all this data, direct material, direct labor, all of the components of our actual manufacturing overhead, how many machine hours were used and how many direct labor hours were used. And the first question we're asked to do on this is to calculate the cost of Job 99 under an actual costing system. So actual, I'm gonna go back to the data here, actual is exactly what it says, you're just using actual data, and it's all in this chart. So why don't I give you a few minutes to think about that and summarize the cost of this job under actual, and then I'll walk you through it, and then of course we're gonna do a normal costing as well, where we use budgeted allocation rate. So just to help you out, all of these components right here are components of actual overhead. So the sum of those gives you your overhead allocation. And remember, every job is three components: direct material, direct labor, and manufacturing overhead. So this is really just an addition problem. There's not too much going on here. I'm doing some math for you. Are we ready? Are you bored with this already? Do you want me to walk through the solution, or do you need a few more minutes? Are we good? Okay, I'm gonna move forward so we have plenty of time. So remember, Job 99 consists of two departments, right? We have Department 1 and Department 2. And you always have the three components of any job costing system. You have direct material, direct labor, and manufacturing overhead. And so we were given all of that in the problem. Go back here, direct material is 13,000 and 5,400. Direct labor is, it's back here in the chart, 21,000 and 21,400. And then manufacturing overhead is the sum of these four categories of cost. So I think when you're looking at a chart like this, if you see a chart and there's something like selling expenses, administrative expenses, so on and so forth, that's not manufacturing overhead. In this case, all four of these categories, indirect materials used, lease on plant equipment, indirect manufacturing labor and plant utilities, those are all manufacturing overhead costs. So to do an actual costing, all you had to do was add those up. So then you get 14,300 for Department 1, and Department 2 is 7,500. Those are the three components of costing a job. You add all that up. I'm sure I had it at some point added up, but I don't seem to right now. I'll do it really quick. Plus 21 plus 14,3 is 48,300. And then we have 5,400 in direct materials plus 21,400 in direct labor plus 7,500 in manufacturing overhead. You have 34,300. Those are the total costs per department. Add those together and you get total cost for job 99 of $82,600. Any questions? Are we ready to go to absorption? Everybody clear on this? Yes.
Can you just go back to, I can see, okay, just, I was trying to see which,
What we added up?
yeah, it's a manufacturer.
Yeah. Basically everything, because there were, there's nothing extraneous thrown in there really. So it's just the four categories are clearly manufacturing overhead. So that would be the most important thing, is being able to identify what would be considered manufacturing overhead.
Okay.
Okay? So remember, your actual manufacturing overhead is 21,800. Okay? So now we're gonna do this same calculation of job 99 under a normal costing system. Can somebody tell me what you do in a normal costing system? Yes, you use budgeted, you calculate a budgeted allocation rate. So just associate normal with budget. So let's do that really quick. Let's go back here to the problem. We were told that Department 1 has $23,000 in budgeted overhead, and it has budgeted production of 5,000. And that math gives us 4.6 per unit, per machine hour, because Department 1 uses machine hours. And then, so this is Department 1. And then Department 2, we were told has 25,000 in budgeted overhead and 2,500 direct labor hours. So this is gonna equal 10 per direct labor hour. Again, I wanna make sure that you notice that we're using machine hours in one department and direct labor in the second department. So this is your budgeted allocation rate. And that's the only difference between absorption costing and actual costing. Is actual costing, you just use actual overhead, and then we're going to apply overhead based on budget and absorption. Sorry, it's the only difference between normal and actual. I'm mixing up terms. Forget that I used the word absorption. We're getting to that one next. All right, are you ready to summarize it? Okay, it's very similar to the one we just did. We have Department 1 and Department 2. You always have three components of a job: direct material, direct labor, and manufacturing overhead. And the only thing that changes is manufacturing overhead. So again, you had 13,000 of direct material, and you have 5,400 in Department 2. We have 21,000 of direct labor. None of this changes, it's exactly as the last problem. and then we have 21,400 direct labor in Department 2. Now, manufacturing overhead, for Department 1, we calculated 4.6 is our machine hour rate, and we're gonna multiply it by, remember, you apply the rate to actual input. And Department 1 has 3,020 machine hours. So we're gonna multiply that 4.6 times 3,020 machine hours, and that gives us 13,892 in overhead cost. Does everybody see how I got that? Then remember, we calculated Department 2 as $10, but this one we had to multiply by direct labor, and you have direct labor right here. And remember, we're not using these other amounts because, I mean, it's important information internally, but it's not important for calculating overhead. But because Department 2 allocates on the base of direct labor, then we're gonna multiply the 10 times 710, and you get 7,100 in manufacturing overhead. So everybody follow that. So calculate your budgeted allocation rate for each department, and then apply it to the applicable level of output for each department. Then we're gonna sum these up. Sorry, I keep making a mess here because I have calculations. So we're gonna sum this up to be 47,892, and this will be 33,900. Sum of those gives you 81,792. That's a dollar sign. For job 99 under absorption costing. So everybody clear on that? Direct material, direct labor is exactly the same as variable costing. It's just that you're applying, because this is normal costing, we use the budgeted allocation rate for applying overhead. Any questions? Because now we're gonna make journal entries. Yeah. You will see this, almost this very similar problem. You'll see a chart like this that says job number whatever, and you're gonna accumulate the cost under both normal costing and then under absorption. So you will see almost this exact same type of problem on the exam. Are we good? All right. So now we're gonna prepare the journal entries to close the variance associated with job 99. So if you remember, when we use normal costing, we use overhead control and overhead applied, and those are temporary accounts that we have to close out to cost of goods sold. So the two journal entries to close this out are, and so let's just summarize some costs for a minute, okay? So let's go back here. The sum of these two numbers, 13,892 and 7,100 is, hold on a second, yeah, 20,992. That is applied or allocated overhead. Those words get used interchangeably, so if you see either one, they're the same. And then actual overhead, let's go back to here. If we take 14,300 plus the 7,500, we get 20,992. Oh, sorry, I'm on the wrong number. Actual is 21,800. I wanna make sure everybody knows how I got those numbers. It's just the sum of applied overhead between Department 1 and 2 under absorption, and it's the sum of actual overhead for Department 1 and 2. So then we always close out applied to overhead control. So remember, we record actual in overhead control, and we record applied into overhead applied. Those are the accounts that we're talking about. So if we've already recorded those, then to close out those accounts, you're gonna debit overhead applied or allocated, same thing, and you're gonna credit overhead control. Sorry, pen is not being nice to me. Let me try again. Overhead, this is a credit, overhead control. Sorry, pen pen is not cooperating, but just know that's overhead control, that's your credit. So you're closing out your overhead applied, and we know we recorded 20,992 into applied. So that means to clear it out, we're gonna debit 20,992 to applied, and we're gonna close it out to overhead control for 20,992. Now, the difference between these numbers, actual and applied, is actually 808. If you just do the math, 21,800 minus 20,992 is 808. And we close that out, remember we close it to cost of goods sold, and then we recredit overhead control for the 808. Those are the two entries that you will be asked for, so that's closing it out. Now, do you want me, there's actually two more journal entries that help you kind of get to what the numbers are. Would you like for me to do those, or should I not overwhelm you with that? Don't go there? All right, so, yes.
I understand how you got the 808, like the difference between actual and budgeted, but the first two numbers, I guess I missed how you
Yeah,
got
so
those.
20,992 is, sorry, I have to keep my numbers all straight, is actually your allocated overhead. So it's the sum of 13,892 and 7,100. So that's what you applied, so that's your applied overhead. And if you go back a sheet, your actual overhead is this 14,300 plus 7,500, and that gives you 21,800. So those are those two numbers. And then to close them out, you're gonna close out applied to overhead control. And then you close out the difference between those two accounts to cost of goods sold,
Okay, that makes sense.
okay? Any questions on this? Would you like for me, I can draw T accounts, I can walk you through the other journal entries, but if you're clear on this, this is what you're gonna be asked to do. It's kinda messy, sorry. Any questions? Wanna keep going? All right, so the next thing is, can anybody tell me if overhead for job 99 was under allocated or over allocated? I'm gonna repeat the numbers for you. Yeah, it is under, because your actual is 21,800 and your applied is the 20,992. Your actual is more than what you applied, so you are under applied. So that's why we're debiting cost of goods sold, because we have to bring our cost of goods sold up to what our actual manufacturing overhead was, or is. So in this case, we're definitely under allocated. And the opposite would be true if you were over allocated. That would mean your applied number would be greater than your actual number, and you would credit cost of goods sold instead of debiting. Questions? We're gonna move on to another topic, so I wanna make sure that this overhead control and overhead applied is clear, yes.
For the journal entries, would I be able to just do, like, say I have all of that, but almost simplified it, so I didn't have two separate overhead controls, I just had one overhead control with the total amount, like adding the 808 back to the 20,992, and then just had COGS 808 overhead applied 20,992.
When you only have one overhead control account, but you're having to make two journal entries to clear it out. So
Okay.
let's talk to, I'm gonna draw the account, is that all right?
Yeah.
I'd feel better if I did it. So we have overhead control and overhead applied. We always record actuals to overhead control. And that's the 21,000, so you're gonna debit 21,800. And your credit is to various accounts, lease expense, water, you're just accumulating all the overhead accounts and you're recording it into overhead control. And then you're gonna record overhead applied, which is gonna be a credit of the 20,992. And the journal entry is debit work in process and credit overhead applied. So now you have a debit of 21,800 in overhead control and a credit in overhead applied of 20,992. To close out overhead applied, you have to debit it, 20,992, and your debit is to overhead control. And that was the first journal entry that I gave you, which was debit overhead applied and credit overhead control. That was the first journal entry for the 20,992. So now you've zeroed out this account, which is the goal because it's a temporary count, but now you have the 808 balance, sorry, it's over here, 808 balance in this account. So now to zero out overhead control, you have to debit cost of goods sold and credit overhead control. And notice that you're crediting because you're sitting on a debit balance because the actual is really going to apply for the 808.
Okay, there'll always be two separate entries.
Yes, to close it out, yes. So you'll always have to close out overhead, because the question is, let's go back, it says, prepare the journal entries to close the variance. So you always have to close the overhead applied to the overhead control account, and then you have to write off the 808 or whatever the number is that's left in overhead control, because now that you've recorded the credit to 808, you have now zeroed out this account.
Okay,
So both accounts are now zero, and that's the goal.
that makes sense.
Yes.
I think on the homework I was getting mixed up because I had all the same thing. I moved COGS above, so it's like debit, and then just one credit to overhead controls with like the total amount plus the 808.
Okay? Is it clear now?
Yeah.
Okay, you have a question?
What would the journal entries look like if it was over applied? Would it be debit to control and then credit to applied?
It would be, yes, so let me do it really, I'll just reverse the numbers, how about that? So we have overhead control and overhead applied. And in this case, let's just say that, I'm gonna flip the numbers, so we'll say that the actual number is, the applied number is 21,800. And then the actual number is 20,992. So notice I've just flipped them, because over here it was the other way around. And then again, you have to close out applied, so the journal entry to close out goes the same direction. It's, yeah, so that one is the same direction because you're just closing out. So you're still gonna debit overhead applied and credit overhead control. And then, so though that entry's the same, right? But you're gonna, because this went the other way, you are now sitting on 808 credit in overhead control. So to close that, you're gonna have to, do I have it going the right way? Yeah, I'm sitting on a credit, now that needs to go the opposite way, hold on, let me make sure I'm doing it right. So debited. So you put actuals in, which I did, and you close out here 21,800. And in this case, we over applied. So here we're over applied because we applied more than our actuals were. So we need to get our cost of goods sold back to the right amount. So we're gonna credit cost of goods sold for 808 and debit overhead control for 808. Because you're sitting here on a credit balance, then you debit 808 and you close that to zero. So really, that's the only entry that's gonna flip. Because closing overhead applied to overhead control is always the same. Whatever balance is in there, you close it out. It's when you go to figure out, was actual more than applied or the opposite, will tell you which direction you make the cost of goods sold entry. Does that make sense? Okay, good.
I would have questioned like this like on the exam because like with it being online, is there like, can we draw, like, are we gonna be asked to draw that?
No, you're gonna have a drop-down box, it's gonna have a debit and a credit, and a debit and a credit, and you're gonna, I think it's drop down, or it may be actually you write it in. I'll look at it in just a minute when we go over the exam, I won't show it to you, but you're gonna have a debit and a credit, and you're just gonna put in there what you think is the dollar amount, what you're gonna put in the account and the dollar amount. So it's formatted, but it will be these two particular interests, the closing out overhead applied to overhead control, and closing overhead control cost of goods sold, okay? And then in this case, you will not be asked to, well, this is not the right one, never mind, it's all running together in my head. You'll be asked to calculate normal costing, costing under the normal costing system, and then costing under the actual, and then once you're asked to do the normal, you'll be asked to make these two journal entries. So I wanna make sure it's clear. Any more questions before we move on to the next topic? Everybody good? All right. So the next topic is financial statement effects, and this is where we're doing absorption versus variable costing. So in this case, we have microphones that we sell for $40 a unit. And in the first month, they budgeted production of 3,000 units, but also produced 3,000 units. So budget equals actual, so there's nothing fancy there. And 2,250 units were sold. So we produced 3,000, we sold 2,250, that means finished inventory is 750. They gave us that number, they didn't make us calculate it in this one. Actual fixed costs are same as the amount budgeted, we have that right here. And other information is $19 per unit variable manufacturing, $1 per unit marketing, and then you have your fixed manufacturing cost of $30,000 and fixed administrative cost of $6,000. So the first thing we're asked to do is to present an income statement using variable costing. So I'm gonna walk us through that, all right? So remember, a variable costing income statement is a contribution margin income statement. So let me remind you that contribution margin is revenue minus variable cost, and what you have left over is contribution margin, and contribution margin is what you have left to contribute to covering your fixed cost and operate and recognize an operating income. So all variable costs are taken from revenue to get to contribution margin. Is a variable costing statement a GAAP statement?
No.
That's correct. Is absorption costing a GAAP statement? Okay, something you will see that. Just make sure that you know that absorption costing is GAAP, variable costing is not. Variable costing contribution margin statement is just used internally for analysis. All right, so let's walk through how we do it. So we're gonna get sales revenue. We were given all this data. We sold 2,250 units at $40 a unit. And that gives us $90,000 in revenue. Let me show you, we were just given that. $40 and we sold 2,250, okay? Then we have to calculate our costs, our variable cost of goods sold. And I just wanna remind you that in variable costing, you only include variable cost in cost of goods sold, and all your fixed costs are expensed as a period cost. So now we're gonna do beginning inventory is 0. Then we're gonna calculate the cost of our production. This pen is not cooperating. That says production, in case you're wondering. And that we produced 3,000 units at a variable cost of $19 per unit, and that gives us $57,000. Let me show you where I got that. Back here, we produced 3,000 units at $19 per unit. Okay, that was all given to us. Then we were told that we have ending inventory, or we could have calculated it, but we were told it's 750 units in ending inventory at $19 per unit, which that ending inventory accounts for $14,250. So we're gonna net that against the production to get cost of goods sold, and we're gonna get 42 $2,750. And that is our cost of goods sold under the variable method. And because we're doing a contribution margin statement, we have to account for variable marketing cost. Again, we were told we sold 2,250 units, variable marketing was $1 per unit. So we have $2,250 in variable marketing cost. We're gonna deduct both of those from our revenue to get contribution margin of $45,000. That's just the math. 90,000 minus 42,750 and 22,50. Then we take out all of our fixed costs. So we have fixed manufacturing. I'm gonna do MFG of 30,000. Because remember, contribution margin is what we have left over to cover our fixed cost. And we have fixed admin of 6,000. And we take both of those out and we end up with 9,000 in operating income. Any questions on this? Yes,
The contribution margin comes after the variable marketing.
correct. All variable costs come out of revenue to get to contribution margin. And then what's left over goes to your fixed cost. Now, you will not be asked to prepare this statement on the exam. What you will be asked is, what is operating income under the variable costing method? And this would probably be what you would do on your cheat sheet to get there. Not your cheat sheet, your scratch paper. This would be how you would walk yourself through it to get to operating income.
I do have a question.
Yes.
I guess the way that I kind of get contribution margin is just by multiplying the units sold by the manufacturing cost. Is that okay, or should I be doing it this way with any inventory?
Yeah, I think you can do the same thing. So you're gonna get 2250 times 19, right? So that's gonna give you the 42,750. So if you wanna do that shortcut, you can. I think the reason we do it this way is just to make sure that everybody's understanding inventory flow, because inventory flow with beginning and work in process and finished goods kind of ends up with cost of goods sold, so it's just reinforcing those concepts. But yes, if you wanna just do a shortcut, take the number of units sold times the variable cost, then you'll get the same number, 42,750. Yes,
Are there gonna be questions on the test about how managers can manipulate income statements to meet
Yes,
certain quotas?
there is, yeah. We'll get to that in a minute. Is that all right?
Yeah.
I think it might be the next question, as a matter of fact. Well, no, we have to do absorption first, because remember, it's absorption, and maybe you don't remember, but absorption is the one that allows a department manager to manipulate, because you're putting manufacturing costs as the cost of product in the balance sheet. So let's walk through that one. So that's the next one is, we have all the same information, but this time we're gonna do absorption costing. Does everybody remember what absorption costing is? The easiest way to say it, in my mind, is you are absorbing the fixed manufacturing cost into cost of goods sold. So that's what absorption is. So the only difference between these two methodologies is you're adding an allocated manufacturing overhead to the cost of the product, where variable is just variable cost. This is your GAAP income statement. You will get asked that question. It's called a GAAP multi-step income statement. All right, so let's do it. Sales revenue is exactly the same. 2250 times $40 per unit, and we have $90,000 in sales. Then we have to calculate cost of goods sold. I'm gonna do it the same way we've been doing it. We have beginning inventory is 0. We have production. We know that we produced 3,000 units. And we're gonna multiply that by our $19 per unit variable cost, but we have to add in our manufacturing overhead. So let's go back and do a calculation. We were told our fixed manufacturing costs are $30,000. We manufactured 3,000 units. You could do that math and you get $10 per unit. So that's the overhead, manufacturing overhead applied. So we're gonna go back over here and add in the $10, so our total unit cost is 29, 19 variable and 10 fixed. Multiply that times 3,000 and you get $87,000. Cost of goods manufactured. Then we have to take out the ending inventory, which we were told was 750 units. You're gonna multiply that by the same, $19 variable plus $10 in manufacturing overhead. Do that math, you're gonna deduct $21,750 of your cost of goods manufactured that stayed in inventory, didn't go to cost of goods sold. And the net of those two gives you cost of goods sold of $65,250. Deduct $65,250 from $90,000 in revenue, you get gross margin of $24,750. Then, all your other non-manufacturing costs are deducted from that, including variable. Remember on the variable costing, variable was above contribution margin, but here you go to gross margin. Gross margin is what you have earned on the product or service that you sell, and then you cover all of your overhead costs. So then we take out our marketing, which is variable at $2,250 times $1, gives you $2,250. And then you have admin of $6,000. And that gives you $16,500 in operating income. So really the only difference between these two is you have to add in your manufacturing overhead because you are absorbing manufacturing overhead into the cost of the product or the cost of goods sold. And then also where is that marketing cost is in a different place because it's variable. In contribution margin, it's part of calculating the contribution margin, but here it goes below gross margin. Any questions? Yes.
So just so I'm understanding, I'm probably just repeating exactly what you said.
That's all right.
But for this one, cause I have gross margin, but I was like, oh, maybe there's also contribution margin after variable marketing, but there's not.
Not in this statement.
Okay.
Not, so just try to think of those as separate, right? So contribution margin is just used internally for financial analysis and maybe for compensation for department managers. And absorption costing is a GAAP statement, and this is how it flows.
Okay.
And then to go to your question, why would a company not choose the income reported in its annual report, which is a GAAP income statement, as the basis for compensating its managers? Does anybody remember why this could be a problem? Yes?
Cause if you produce way more than you sell, it allows you to subtract off the ending inventory and make the operating income, make the COGS less, which makes the operating income much higher.
Exactly right. So it's under absorption costing, you can sort of put cost into the inventory. And by doing that, just exactly what he said, it lowers your cost of goods sold and it increases your operating income, and often managers are bonused on operating income. So they can manipulate operating income if they wanted by increasing production over sales. So does anybody remember what kind of things you can do to keep that from happening? What are the alternatives? Because this question is on the exam. Like, what are the things that you could do to keep maybe internally so that you could keep this from happening? Does anybody remember?
Don't use that.
Don't use this, don't use absorption or gap, maybe use variable. The other one be, you can assess an inventory carrying cost, because if you have a department manager who increases production, they just shoved a lot of their costs into inventory. So if you have an inventory carrying cost, that sort of neutralizes that. You can also use a combination of financial and non-financial information. So just remember that there are things, there's one slide in the end of that deck, that financial statement impact deck that explains those, and you will definitely see a question about that. So, I can give you an example of, I worked in a company that had 15 manufacturing facilities, so it was fairly easy for a production manager to increase production if they wanted to manage operating income, because they were all bonus. So what we did was, we would make their bonus multi-step. So you might get compensated on operating income, but you also had an evaluation of were you carrying too much inventory, and then what would you do with cash flow? Because if you produced a bunch of inventory, then you used a bunch of cash to do that. So we always had a multi-step analysis of how somebody earned their bonus. So, all right, we have a few minutes left. While I'm not going to show you the exam, but I am gonna pull it up and kind of walk through so that you can take notes, and I'm gonna give you some specifics sort of around the kind of questions that you can expect. So, like I said, I'm not gonna show it, so. Any questions while I'm pulling this up on what we covered today?
I have one.
Okay,
The $10 that we added that we took from the fixed manufacturing costs, what's that called?
that's called the manufacturing overhead allocation. You didn't take it, you actually multiplied by it. So you had $19 in variable cost and $10 in manufacturing overhead. So you put 19 and 10 is 29, and then you multiply that by the number of units produced and the number of units left in finished inventory. And we calculated that by taking the 30,000 in fixed overhead divided by the 3,000 units produced. Make sense?
Yes.
Okay, good question. All right, I am in, let me get in the right course. We don't want 2303, we want 3320. All right, get your note paper ready. And again, you have a practice exam out there, so a lot of this is on the practice exam, and everything that I've gone over in this slide deck that we did Monday and Wednesday is from the practice exam. So all of this should look familiar even when you look at the practice exam. So we have several multiple choice questions. You will have, one says, what kind of information is used in management accounting? So if you go back to the first chapter, we talked about financial accounting, we talked about management accounting, and we talked about cost accounting. So just make sure that you could pick out from a multiple choice question what kind of information is included in management accounting. And it could be all of it. Then you will be asked what kind of cost is inventoried when using absorption costing. Just a reminder that the difference between absorption and variable is that you are inventorying fixed manufacturing overhead. You are also inventorying variable manufacturing cost. But if you see things like administrative, selling cost, those are not inventoriable cost. Okay, so just make sure that you know and understand an inventoriable cost versus a non-inventoriable. Does everybody know what I mean by inventoriable cost? That's the cost of goods sold, that's the cost of product. We are accumulating it, putting it into inventory, and we only expense it when we sell the inventory. So just think of an inventoriable cost is only manufacturing or product related. Okay? Not selling, not marketing, not administrative. That's the main thing you need to remember. Make sure you know what cost assignment is. That would be in the first chapter, cost concepts. You will be asked to calculate the total manufacturing cost for a job. You will be given the company information, you will be given the job information, and you'll need to calculate total manufacturing cost using a normal costing system, which means you're gonna use budgeted information to do an allocation rate. And then you have to put a number into a box, calculate the actual total manufacturing cost. That's very similar to the first question that we did today. I just have to know it's gonna be done under normal costing, okay? Question 5, you should know what a manufacturing firm uses an indirect cost rate to estimate. So just think about what are we allocating in all of these examples. Every product has direct material, direct labor, and manufacturing overhead. So we tend to use indirect costs to allocate manufacturing overhead. So in all cases, we're allocating manufacturing overhead, unless it's, even if it's actual, we're still allocating it to the cost of the product. Then we did this problem, a similar problem to this on Monday. If sales double, what happens to operating income? If sales double, variable costs double, fixed costs remain the same, and you'll have to calculate operating income in that scenario. You should know whether or not small items like glue or nails is considered a direct material or an indirect material. And I think you can say, like I always give you the example of the direct material in this Yeti bottle is plastic and plastic and steel. And then there's other small indirect costs that go into accumulating this, that's more of an indirect cost. Because glue is probably used across multiple cost categories and not specifically allocated to this product. That's a true or false question. Then you're gonna have a question about, it's very similar again to what we did, probably not today, but on Monday, where you're given all the company budgeted number, and then you're given the actuals for a particular job, and you will calculate the annual manufacturing overhead cost allocation using normal costing. Just remember that normal costing is a budgeted allocation overhead rate, and we'll apply that to get the annual manufacturing overhead cost allocation. Pay attention to words like, are you calculating the annual overhead cost, or are you calculating a company cost or a specific job? Because in this case, you're given a job and you're given a company. So just pay attention to those words. Then you'll be asked to identify if certain categories of manufacturing cost include, what does manufacturing cost include? Just remember, if you see selling, general, administrative, marketing, those are not manufacturing costs. Examples of manufacturing costs are lease expense but make sure it's for the plant, not for the corporate headquarters, right? The general manager's salary, utilities, electricity, anything related to manufacturing. So just make sure that you understand what goes into manufacturing costs versus what is a non-manufacturing cost. Then you have a question where 12 points, that's a bunch of matching. And it's really just understanding those cost concepts, understanding how you transform a raw material into a finished product. I want you to remember what conversion costs are. Conversion costs are direct labor and manufacturing overhead. Because you get raw material, you buy raw material, and in order to turn it into a product, you're gonna use direct labor, and you're gonna incur all of the manufacturing overhead of the plant, and those are conversion costs. Direct labor plus manufacturing overhead. Don't forget it, because you're gonna see it in this matching, and you'll also have to calculate it in another problem, okay? if a company manufactures more inventory than they sell, sorry, my Oklahoma accent, I turned single syllable words into 2 syllables. If a company manufactures more inventory than it sells, just know what happens under variable costing versus absorption costing. And we talked a lot about if you, produce more than you sell under absorption, your operating income is higher because you put part of your cost of goods sold into the balance sheet and inventory.
You said it,
Under absorption costing, if you produce more than you sell, your operating income will be higher because you absorbed part of your fixed manufacturing overhead into inventory where it's held in the balance sheet and inventory until it's sold. So that allows you to increase operating income. Then you'll have a problem. This will be very similar to one that we did on Monday, where you'll be given, certain pieces of the picture, and then like cost of goods sold or direct labor and materials purchased. Then you will be given the beginning and ending inventory balances for direct material, work in process, and finished goods. And I don't know if you remember, I drew it all out and I had the direct material T account, the work in process T account, the finished goods inventory account, plug in what you're given, and then you have to calculate the other amounts. And if you don't remember this problem, it'll be in the practice exam, okay? So, and then after you plug in all the numbers in the T accounts, you'll be asked for manufacturing overhead, conversion costs, direct materials used, the manufacturing allocation rate, and cost of goods manufactured. And this is all from that inventory flow section of, there's always 3 categories of inventory: direct material, work in process, and finished goods. And there's a diagram if you wanna put it in your sheet, your crib notes, and that how things flow. All right, you will be asked, this is similar to what we covered today. For service organizations, a consulting job, you'll be given revenue, direct cost, which is the professional labor, and the indirect cost. You'll have to calculate operating income, and then you will be told what the direct labor costs are for a particular job, and then determine what the firm needs to charge in order to get an expected operating income margin percentage. Let me give that a little bit more detail. You'll have to calculate operating income, which will be easy because you're given revenue minus the cost. Then calculate an operating margin percentage, which is your operating income divided into your revenue. And then once you have that percentage, you'll need to apply it to your direct labor cost. And then you also are gonna need to understand the indirect cost relationship to revenue or to direct labor. And then you're gonna have a question like we did today. You're gonna calculate revenue once you're given a billing rate and expected hours to bill. That's exactly what we did today. And we did it on Monday. And then you should make sure you understand, what under allocated is versus over allocated. You'll have a pull down menu to select the answer. Then you're gonna have a question where you will calculate the total cost of a job under a normal costing system. And you will be given all the data for Department 1 and Department 2. And you will be given the budgeted information because it's a normal costing system so that you can calculate a budgeted allocation rate. And we have a difference in how Department 1 is allocated and Department 2, so it's almost exactly the same question we did today. And then you'll be given the same data and asked to calculate the cost under an actual costing system. So you'll be calculating, total cost under a normal costing and under an actual. And we did both of those today in that problem that we did, where you have the two departments and one allocates machine hours and one allocates direct labor. Then you're going to be given, Department A and Department B, and this company uses normal costing, and you'll need to work through what the overhead allocation is, and then you're gonna prepare the journal entries to close the variance associated with this job. And you'll be selecting, back to your question, somebody asked me, how are you gonna do this? It gives you, you have a debit, and then you have a whole list to choose from. You'll choose the account, and then you'll have a list of 1, 2, 3, 4, 5, 6 numbers, and you'll select the dollar amount. And then for the credit side, you'll be given a list of 6 accounts, and you'll choose what the account is, and then you'll choose the numbers. Hopefully you will have already done the calculations and know. And then you'll do the same thing for the cost of goods sold and the overhead control. You'll be given a list of accounts to choose from, and then you'll be given a list of numbers. You'll have to kind of walk through the numbers and then choose those journal entries. We're almost there, I promise there's only 22 questions. And then you have Cinderella Company is gonna sell some rings, and you are gonna calculate operating income under variable costing, and then you're gonna calculate income under absorption costing. So we did that today. Now the questions we did today said compute an income statement, which is probably the easiest way to do it, or if you wanna do it your shortcut way, where you just take how many units are sold times the variable cost to get your cost of goods sold, but either way, you're gonna have to calculate and know your cost of goods sold, and you're gonna have to know what you're doing with, fixed costs, or whether or not you're allocating them, and you're gonna calculate operating income under both those methods. And then you're going to be asked on a variable costing income statement, what you are looking for. Gross margin or contribution margin. Same thing, under an absorption costing method, are you looking for gross margin or contribution margin? And then you need to know which one of those statements is GAAP. I hope you get that one. I've said it a lot, haven't I? Sometimes I feel like a broken record, but it's a lot of data coming at you, so I really do try to repeat the things that are, given. All right, last one. This goes back to what is not, you'll be checking a multiple choice, what is not a possible option to dissuade managers from manipulating operating income on the income statement. So there's a whole list, and there's a slide on the last slide in financial statement. Financial statement effects. In that lecture deck, there's a whole list of things that you can do to try to prevent this manipulation of income under absorption costing. So just make sure you know that deck or that slide, and then you'll have to click some things on a multiple choice. And that's all. Easy, right? All right, have a practice exam. I will see you here with your laptop on